Thanks, Gugu, and thanks to the Business Day for having me. I see one of my competitors, Satrix, was actually the passive sponsor today, but we're such a cordial bunch that they've given me the speaking slot. So my turn next, and congrats to Satrix on some of their recent launches. So my topic is obviously my personal favorite, the power of passive. And as I get into the conversation, I've got some very exciting news for you. Did you know that there's a third stock market starting in South Africa? It's going to be called the BusinessDay Exchange, and it's starting in about 2 minutes' time. We probably have about 25 companies listing, maybe 27, 30. The number doesn't matter so much. But we're going to list these new companies. It's going to be very, very exciting. I need about 100 of you to participate, and I'm going to ask you for $1,000 each. So we're going to start with a market cap in this new stock exchange of 100,000 Rand. Okay, 25 odd companies, initial market cap of 100,000 Rand. This half of the room, or 50 of you over here, I'm going to take your 50 grand, and we're going to put you into an index fund that is very simply going to track the market. What do I mean by that? We're going to put that 50,000 Rand into each of the 25 shares, depending on the size of those companies. Obviously, the bigger the company, the more capital that they need, but they're going to be in an index fund. On that index fund, we're going to charge, say, 0.25% on the index fund, right? This half of the room, we're going to get 50 people on this side. You're also going to give me $1,000. And I'm going to ask you, just look around the room and find your favorite stock picker, asset manager. Where are you? Come, guys, hands up. Stock pickers, there are a few of you in the room. Great, couple there, thank you. I want you to sort of cuddle up to those guys because they're going to give you advice in terms of which of these 25 shares are winners and which are losers. And because they're such smart people, they're going to charge you 1%, okay, for their service. All right, so 10 seconds till the bell goes off. How are we feeling? This camp's hell of a positive. This camp feeling pretty sure of themselves too. Ding, 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 ding. Patience. Patience. Remember, investment's a long-term game. Ding, ding. The year is up. The year is up. How has this new stock market done? Well, everybody, the new stock market collectively returned 10%. 10% on 100,000 Rand is 10,000 Rand. Okay, so this half of the room, how did you guys do? Well, you received the index return, which was 10%, so you got your half, the 5,000 Rand. But remember, you had to pay the index fund 0.25, which means that your net return is 9.75. All right, 9.75, not too bad. This side of the room, let's have a look around. Mr. Smith over there, he's got a massive smile on his face. He earned 15%, well done, well above the market. That stock picker who put you into those shares took 1, so you're down to 14. Hopefully you don't have to pay performance fees over and above that. This lady over here is looking a bit forlorn. I mean, she only got 5%, and the stock picker still charged her 1%, so she's only on 4. I see another person who earned 8, and another who earned 12. But hang on, let's see how you did collectively. If I add you up collectively, well, you, as a collective, also only earned 5,000 Rand in returns, or 10%. But collectively, you paid the stock pickers, the active managers, 1%, which means that as a group, you earn 9%. But hang on, you guys earned 9, they earned 9.75. And I present to you the undisputable maths of the active versus passive equation. And it's this sort of philosophy that is perhaps not fully understood in our markets today, but it is a philosophy that is well understood by this man, John Bogle. Who knows John Bogle in the room, just by the way? Come on. Great. So John Bogle is considered by Times as one of the top 100 influential people in the world. He founded the Vanguard Corporation in the mid-1970s and set into motion the concept of the index fund. All right. He was recently praised at the CFA conference in Philadelphia for his contribution to finance. The Vanguard Corporation today, by the way, manages over $4.4 trillion, making it one of the biggest mutual fund companies in the world, if not the biggest. Bogle has always had his critics. When he first brought out the index fund in the US, it was called un-American. And he has, over his life, imparted many wise words and, in fact, put together many clever things. One of the clever things he's put together is the nature of the company of Vanguard being a mutual, which means that the profits of the company are basically given back to clients over time. So he's provided clever structures, but he's given very, very good advice over time. I haven't necessarily always agreed with everything he said, by the way, but let me paraphrase a few of his simple lessons. The first is keeping it simple is smart. And how we like to complicate things in the investment world. And we've had a few discussions around that this morning, around how we tend to make investments more complicated than it need be. Bogle, as I say in the quote here, says that simplicity, or the majesty of simplicity. And when we talk about simplicity being smart, and we look at the active versus the passive camps, S&P Dow Jones Indices puts together a regular report called the SPIVA, S&P Indices versus Active, wherein they monitor how active managers are doing relative to their benchmarks. And how do you think they do relative to their benchmarks? Well, over the last 5 years in South Africa, 76% of active managers underperformed the SWIX index, whilst in the US, 88% of managers underperformed. Now, when I see clients in South Africa, they say, yes, but Gareth, I'm part of the 12 or I'm part of the 20 because I know the managers that are going to outperform. Really? Do you? You know the managers that performed, not necessarily the ones that are going to outperform. And because actually there is a bit of uncertainty as to the ones that are going to outperform, they tend to start blending a few different active managers just to take some risk off the table. What do you think the probability is of choosing 3 active managers that are all going to outperform over a period of time? It's 0.2%. And the number of combinations that are available to you when picking general equity funds is something like 210,000 different combinations. Okay, so you've got to be working with you've got to be a very, very clever person to pick 3 active managers that are all going to outperform. And the moment that 1 or 2 start underperforming, well then guess what? You migrate back to the average, if not below the average. So keeping it simple is smart. The other thing that Bogle goes on about ad nauseum is cost. Now, I've already demonstrated that side of the audience paid 1%, and this side of the audience paid 0.25%. And that was over a 1-year period. But guess what? That cost is not it's not a once-off thing, it's an annual thing. And it compounds every single year. And we know the power of compound. So in fact, active managers are at a structural disadvantage relative to passive. They start at a significant handicap every single year. William Sharpe, the famous economist, is quoted as saying that someone saving for retirement who uses low-cost products over high-cost products can expect a standard of living in retirement that is 20% higher. So costs matter. Thirdly, Bogle is an advocate for time in the market, not timing the market. With respect to Mr. Brooke, I don't like the idea of trying to bring back money from the US when you want to make a currency call or take it back out again, whatever. I would prefer that investors stuck to a strategic asset allocation that made sense and let time work for them rather than to be clever between different sectors and asset classes and so forth. So time in the market, not timing the market. So as Bogle would say, buy and hold, long-term, and all-market index strategy implemented at rock-bottom cost is the surest way of all routes to the accumulation of wealth. So how's passive doing today? It's flying, is the short answer. ETFs globally are now just under $4.5 trillion. Moody's reckons that by 2024, over half of the money in the US will be passively managed. Moody's also reckons in that same report that shift will happen in other markets. They go on to predict that provided global transparency and communication improves and that global financial markets continue to mature and become more investor-friendly, this passive trend will also take shape in other markets in SA. We're only getting started. All right. So the idea that passive is something that works in the US, it doesn't work in South Africa, is nonsense. It is a trend that's going to happen here. We may only be 3.5% of the market, believe it or not, but it is a trend that will continue to take shape. So what are some of the tailwinds driving the growth in passive? I would say first and foremost, trust. There's trust in the system. Post the global financial crisis, there was a lot of mistrust in the system in terms of how managers were managing money and how banks were conducting themselves. In comparison, there's trust in passive. It's rules-based, it's well-governed, it's diversified, there's proof of concept. None other than Warren Buffett, probably the most famous active manager of them all, is now a firm proponent of passive. He reckons that when he dies, aside from his Berkshire Hathaway shares presumably, that 90% of his estate should go into the S&P 500. Remarkable. Passive is pro-consumer. It's popular with both the regulators and, of course, the saver. And, importantly for this room, I believe it's good for business. It might not be good for active managers, per se, but they've been creaming it for far too long. We are the client's yachts, as they say. But for advisors and producers of solutions, it is good for business. An advisor who's wanting to earn a fee for giving very good advice, holding a client's hand, making sure that they're saving, making sure that they're getting to their goals, they want to drop the product cost out of that solution and therein retain their margin. So it's good for business if you're an advisor, if you are a provider of solutions, if you are a multi-manager, and yes, if you are a consultant to pension funds. It is good for business. So these are just some of the trends driving the passive market, the least of which is trust. But hang on, what about the naysayers? For every positive article that you hear about passive, you hear a rebuttal. And I love this quote by Upton Sinclair, which I pulled out just yesterday. It is difficult to get a man to understand something when his salary depends on him not understanding it. How true. So let's go through some of these rebuttals, because I hear them every other day and I'm getting tired of it. All right, so you're sitting across from the client. As passive represents the average, including costs, I'm guaranteed of getting less than the average. Well, no, actually, because remember the average here was 9%. The average here was 9.75%. That 9.75 was less than the 10, but quite a bit higher than the 9. So if we look at the South African market, equities have given us 8.9% over the last 10 years. Okay, which means that if you were in a tracker fund, let's carry on using the 0.25, you earned 8.65%. The average general equity fund over that time period gave you just over 8%. So by investing in passive, you are actually above the average. All right, so misnomer number one. Passive is a compelling option when markets are going up. But when markets are going down, you need the clever stock pickers to allocate to cash and other defensive assets. Wrong again. If we look at the markets over the financial crisis, over 60% of active managers underperformed the benchmark during the period of over the global financial crisis. So the idea that they will protect during stormy waters is not necessarily true either. Emerging markets like South Africa are inefficient. Passive only works in the States where there's efficiency. Well, no, that's not true either. If you compare the percentage of active managers that underperform the benchmark in emerging markets relative to developed markets, that ratio is very similar. To give it to you exactly, in emerging markets, 72.51% of managers underperform, and developed markets, 74.21%. So our stats and figures read exactly the same as they do elsewhere around the world. And my favorite one of all. How can you put me into an index where you invest 21% in just one stock? That stock being Naspers. Okay, well, first of all, hardly a bad investment, was it? But fair enough. So let's address that point briefly. I would argue that the passive market has actually evolved and has innovated around this particular point. It does not take much computing power to simply add caps to an index where you limit any single stock exposure. So CoreShares, and I know many of our competitors as well, have started to add caps to certain of our indexes so you don't have a skew to one particular stock. Naspers today, 10 years ago it was Anglo's, for example. And so perhaps that point's a nice sort of lead on to the next area of passive, which is perhaps slightly more controversial, and that is smart beta. So for those of you who are not familiar with the term smart beta is the new catch-all term for indexes that are designed in a way that is different to company size. Because remember, the first index fund that I used earlier, company size was the driver for weighting. These indices use other types of variables, like price earnings or so forth. And it's a growing, important part of the market. There's already over $600 billion invested in smart beta, and it's growing even faster than traditional passive. It's been called the commoditization of the active fund management industry. So the guys sailing around in the yachts, a lot of what they were doing in terms of their investment principle, well, I'm a value manager, I select shares based on a value metrics, or I'm a quality manager, I only have blue chip stocks in my portfolio. Those types of investment philosophies can now be built into an index, and the cost dropped out of it. Is this a departure from the simplicity of passive and the whole sort of debates that I opened up with? Perhaps. But, and here's the important but, with smart beta, you are able to manage risks, down-weighting Naspers, an example, lowering of volatility as an example. You're able to build outcomes, and you're very often able to achieve a better risk-adjusted return. So it is, in a sense, a hybrid between active and passive. It is true to passive in the sense that it's low cost, it's rules-based, transparent, well-governed, and diversified. So at CoreShares, we believe in passive. We think that it complements vanilla beta, the simple index fund, if you will. It complements it quite nicely for those reasons I've given, and is a suitable replacement to other active strategies. We would, however, urge that, given that there's been quite a lot of product proliferation within this space, that you choose those smart beta strategies carefully. They need to be well constructed, they need to be grounded in academic work, and so forth. And then last but not least, I heard robos being discussed earlier, another area of great intrigue to us. So some of the better names in the robo world today, so I'll give you the two very big ones, Vanguard and Charles Schwab, who don't just do robo, but they're probably the two biggest robos. And then the other smaller but as sexy robo-advisors, Wealthfront, Betterment, and Nutmeg, are hailed today as the kind of brands to look at in the robo space. And guess where all of that advice backs into? Where robo-advisors generally, how they generally select investments? Well, they go to passive. They use passive tools, passive benchmarks. Why? Passive is programmable, and it's compatible with algorithms, advice algorithms. It's reliable, easy to access, and most importantly, it's low cost and it's highly scalable. Just this week, I read an article on Bloomberg. Don't believe everything you read on there about passive, by the way. Robots are an ETF's best friend. And they quote two stats about the robo-advice market. So PricewaterhouseCoopers, which reckons that robo-advice will be managing up to $800 billion over the next 5 years, whilst an even more upbeat group, the IAT Group, reckons $1 trillion by 2020. Now, there's as many people believing in the robo world as there are that say, well, actually, no, this is not going to work. And that's fair enough. But I think we all know today that you don't want to bet too much against technology. And so I would err on the side of risk-taking in that regard and back the robo trend. However, to sort of contradict myself again, what relates, what of the traditional advisor? I believe that the high-touch advice model is absolutely here to stay. It's about how they reconfigure realign, reevaluate how they're giving advice and how their business model works. That means bringing in technology themselves, adding value, professionalizing the things that they're already doing, but also thinking of the use of passive within their business. So if robos are going to go 100% passive, well then maybe advisors as part of their new refitted world will say, okay, yes, I get some of the arguments there, let's go 20, 30, 40, 50, 60% passive, and then some of your high conviction active managers can support that. But I do believe that they're not mutually exclusive. It's how the advisor adjusts to that new world. All right, and I think I'm exactly out of time. So if you'd like to catch me for some questions or a discussion, I'd love to hear from you over the lunch. Thank you so much.